I'm excited to have our guest Lee Fjord of Green Forest Capital here today. He's out on the road, but thanks for taking some time for being on the show today.
Yeah, hey Ciaara, thanks for having me on. Really appreciate it. Excited to bring some value to your audience.
Perfect. So I always like to start off by asking about your background. What did you do before commercial real estate, and how did you get into it?
So I am now a full-time real estate syndicator, specifically focused on value-add multifamily in the Midwest and Southeast. Prior to that, I was a broker with Marcus and Millichap. Probably heard of them. And before that, I was a property manager. So I started in the trenches as a property manager.
Nice. So, I've heard some investors say before that they used to be a broker and then they're not anymore. Has that experience helped you as an investor? And how come you don't do both at the same time? Is it kind of a conflict or?
Absolutely, it helped me learn, from every side of the table. Learn from the seller standpoint, learn, from the buyer standpoint, learn, the full contract to close process, the negotiation process, underwriting, of course, hundreds and hundreds of deals underwritten in order to be able to give broker opinion of value. So, and then of course, then eventually listing a property for sale. So huge value. It taught me a lot, and I apply those things to my job and my work and my business every single day. And as far as the other side goes, I do a little bit of brokerage. I still hold my license. I still sell some property, some apartments and such. But my primary focus is on being an investor now, focusing on my company, and providing opportunities for people to invest passively.
Got it. Yeah, I've wondered that because, I do have my real estate license, and, I wondered if it would be a good idea for someone who is getting into commercial real estate as an investor, if having that experience as a broker would be a benefit to them as well. So what do you recommend for someone? Should they just focus 100% on just the investing side, or would it be beneficial to also, in the beginning to be a broker as well?
I would say most people should just focus on the investment side. The brokerage job is a full-time job. If you are going at it halfway, you're not going to see the types of results from your true efforts that you might want to see. And especially if you're thinking about commercial real estate brokerage, that's not like residential where you can kind of, sell 3 or 4 houses a year or whatever. In general, if you're going to be a commercial real estate professional broker, that's going to be your job, your job, commute 45 minutes back and forth to work every day, go to your cubicle and do your job. That's what I used to be.
Got it. Awesome. And so how did you start getting into the investment side of things then?
I was inspired by my clients when I was a property manager. So many of my clients were, larger commercial real estate investors, and man, it just seeing their lifestyles, and I wanted to live that lifestyle. So I got inspired by them and decided to take the plunge and bought a duplex in 2017, and it's all been downhill since then.
Awesome. So tell us about your portfolio. I know you just recently closed on some properties. What does it look like today?
Absolutely. We're at 588 doors today. That includes a recent acquisition just this last week of a 138 unit apartment complex. Bought it in a great municipality, Hot Springs, Arkansas. So not just in my own backyard any longer. Now that I'm a full-time investor, I can go more regional and starting to head south, warmer weather and better taxes, population growth.
Nice. So for those who don't know, where is your portfolio mostly located now, and what areas are you looking at that could be potential hotspots?
In and around the greater St. Louis MSA. That's where I live. That's where the majority of the portfolio is. And so generally it's in tertiary markets outside of like the city core. That's where we look. We look in the suburbs usually, or the tertiary townships and markets just outside of the city within an hour or so. So St. Louis, and now we're looking in Missouri, Kansas, Oklahoma, Texas, Florida, Georgia, North Carolina, South Carolina, Tennessee, Arkansas. Yeah, so we look at opportunities in every one of those markets.
Awesome. And I think one of the nice things that kind of has allowed you to scale is being able to syndicate, right, and raise money for some of these deals. So when you first started out, were you just doing it all on your own cash, and then you kind of transitioned into the syndication?
Yes. So I started out with, doing it the wrong way, with all my own money, buying duplexes and four families and single family houses and fixing them up myself, and and buying them for cash and running around and collecting cash from tenants and rents, So did it all the wrong way first with my own money. And then, realized the power of partnerships and being able to scale and buy, scalable assets that you can actually truly afford to have a professional on-site manager, and that's usually, now I've scaled it up. So started with a 38 unit, bought and now have sold a 38 unit. Bought it in 19, sold it in 22 in August of 22. Bought it for 1.3, invested about $250,000 into it, and sold it for 2.5. So my partner and I did very well on that deal.
Very cool.
And then did a 76 unit, a 70 unit, a 272 unit, a 7 unit, and now 138.
Awesome. So obviously, being able to partner with other people has allowed you to scale very quickly. What's the time frame look like on that? From when you first started, and then when did you start, partnering with other people?
When I started partnering with other people, that was in the summer of 2019. So since then, now let's call it so 2 years later, 2022, or 3 years later. So 3 years now has gone by since I started investing, and went from, I think it was maybe 9 or 11 doors to 588 in 3 years.
That's awesome. Yeah. So that's a huge, a huge jump right there.
Absolutely.
Can you tell us and maybe explain for people who aren't aware, the difference between passive versus active investing?
Absolutely. So I'm a big believer in doing your one thing very, very, very well. Be a master of one thing, and then rely on others or delegate to others everything else, or as many other things as humanly possible. And real estate is no different. If a busy professional who is a doctor or a lawyer or, a business owner, and they're very, very, very good at being a doctor or a lawyer or a business owner, and they decide they want to invest in real estate, the one thing that they should do is take into consideration the value of their time and their true best use of that time and their skill level. Now, if a doctor is investing money into the stock exchange, do they go and open up a Ameritrade account and start day trading stocks? I mean, maybe they do, but they're probably hiring it out to a financial advisor.
Right.
They call Edward Jones and they say, Edward Jones, invest my money for me, and then I'm going to, rely on someone whose full-time, day in, day out focus is to be a steward of my money. And real estate is no different. Someone is generally going to be able to achieve similar, if not better, returns on their money with using less of their free time on it, investing passively with those of us who are professional investors, as opposed to going out and, being a landlord and essentially buying yourself a job. That's what you're doing. If you go and buy a 4-family or maybe even a 10 or 12 unit, you're just buying a job. That's all you're doing. Now you got to manage the managers. You got to oversee, the the rent roll and the tenant income and expenses and all of the work that's going on. And oh man, next thing you know, you're getting calls on a Sunday and you're having to go out to the property and deal with some problem. You know, that is the one thing that no busy professional should have to do, because they can rely on someone like me to be able to make sure to be a steward of their money and protect them. Sometimes people need to protect themselves from themselves.
Right.
You know, they might not have the best ability to pick the right property. They might not be, you know, putting the right kind of debt on it. They might not recognize the best timing for a sale or an exit, or have the ability to truly maximize the amount of cash flow you can take from a property.
Yeah, that's a good point. So for someone who has, you know, a full-time job or maybe even more than full-time, a lot of, you know, busy professionals work 50, 60 hours a week. They don't have time to learn the ins and outs of the business, right? So getting into a real estate investment and taking advantage of, you know, those tax advantages with real estate, and because a lot of these professionals are paying a lot in taxes already, right? So a
Yes.
lot of advantages for sure, getting into it as a passive investor as well.
Absolutely. You get to participate in every aspect of the benefit of investing in real estate without having to give up your time, you know. And it also gives you a greater ability to diversify your investments in real estate too. You're not having to go buy properties in your own backyard. You can choose to invest in markets where you would probably not necessarily be able to invest your money, by partnering with someone who can and does operate real estate or own real estate in markets that are potentially better to invest in than where you're at. So if you live in California and you want to invest in, you know, Arkansas or Florida or Georgia or Missouri or Oklahoma, you should probably find a partner who knows what good properties are and how to run a property in those states, and then partner with them passively.
Exactly. Yeah, that's a good point as well, is being able to invest in areas where you're going to get a higher return for your money versus, you know, areas like California where it's a lot harder to get that same return you could elsewhere in the country right now.
Absolutely. My investors, we project to have them achieve between 17 and 21% internal rate of return. So they're average across the hold time frame. And during the hold period, they receive an 8% preferred return. So the preferred return is paid out to the investors' capital, the capital investors, the limited partners. Before the active investor, my team earns a single dollar. So they make 8% of their money before I even start making any money for my efforts. And then after that, we split it, sometimes 60-40, sometimes 70-30. Every deal is a little bit different. But, you know, after that, the investor's capital is still earning well and above that 8% when you include, you know, appreciation, principal pay down, you know, and proceeds from a sale.
Perfect. Yeah, and you mentioned a team as well. So obviously, commercial real estate is a team effort. You need a lot of different people to kind of grow and scale quickly, like you mentioned. So what kind of partnerships did you have to build, and how did you find these people? Like, how do you create these relationships?
Absolutely. I have several partners that I have on each deal, and we all contribute to the, you know, to the team in our best way possible. So I am strong with finding opportunities, getting them underwritten, making sure that they're a good investment, negotiating the purchase, seeing the purchase from contract all the way to the closing day, and then also asset managing the property. So I look for teammates that can help take some of the weight off from the other aspects of the business. Let's say they can fill in on marketing, they can fill in on community relations, they can fill in on you know, asset management, project management, construction management. They can jump in and allow me to continue to focus on finding new opportunities, getting them on the deck, getting them underwritten, so on and so forth. You know, and we all as a team are responsible for raising capital from all of our our network of friends and family and investors. So yeah, that's, we all come together, lean on each other's strengths and raise money for the purchase, contribute money ourselves, of course. And yeah, just, it's a team sport, and I love the game of real estate.
Awesome. And just kind of a side note for people who maybe don't know, I know you're not a lawyer or anything, but there's different types of deals, right? There's 406B and there's a 406C. So, someone who doesn't know is coming in as a new like passive investor, how do you explain that to them?
Absolutely. So, it is a scenario where so the C, you are allowed to market. So you can advertise a opportunity to invest in a 506C anywhere. You can advertise it on Facebook, you can buy a billboard, whatever. You can tell anybody, because you are only going to be allowed to accept accredited investors. An accredited investor is someone who earns $200,000 a year for the last 2 years in a row, or has $1 million in net worth outside of their home equity in their private home. And so that is a limitation. On a 506B, you can accept up to 35 non-accredited investors, but you can't advertise. These are people that you have to have in your network and already have a substantial relationship with before you go and put the property under contract. So the last deal that we did was a 506B, so we were not able to do any advertising. We weren't able to go out and buy a billboard and tell everybody in the world that, we have an investment, vehicle available. So it literally came down to all of the pre-existing relationships we built over the course of the last several years. Reached out to all of our passive investor partners that we had, connections with already, and, said, hey, we've got another one. Are you interested? And then the answer is, maybe the timing isn't right, or absolutely the perfect timing. Let's do it. We have several investors that are repeat investors in our deals as well.
Awesome. How do you decide whether you're going to go with one or the other?
It's kind of the team gets together and you make a decision based upon the deal itself. Whether it's generally a larger deal, you would want to most likely do a C so you can advertise, but it depends on how many people you already have in your network. So if you already have enough people in your network to close out any size deal, then there's no reason to advertise. There's no reason to focus on, blasting it out to the world like, hey, we have a deal, whatever. So we did a 506B on the last one. The one prior to that was a 506C. So have done both.
Okay, perfect. Yeah. So you've got that experience. That's awesome. So now looking back, on your real estate journey, what was the most difficult thing that you had to overcome, and were there any sacrifices you had to make to push the business forward?
Oh, absolutely. I'm someone who is just focused on the end goal, and, I've made mistakes, gone forth with deals that, weren't the right deal and had to pull out. But that's just the nature of the beast. You have to spend time and effort kicking over stones and looking for gold. So I would say, going back to the beginning, I probably would have preferred or should have focused my time and effort on learning and creating a network of other successful real estate people, as opposed to buying a bunch of tools and going to Home Depot and, fixing up a duplex for a year.
Yeah, that's the slow way of going about it, for sure.
That is very much so the slow way.
Yeah. Now, obviously with interest rates going up so quickly this year, how has that affected, your ability to find new deals, and has it changed your investment strategy at all?
It's a very dynamic marketplace out there right now today. The sellers are always the last person to find out how much their property is worth. Literally, they are the last ones. Yeah. So the funny thing is that a lot of sellers are, they are remembering that at one point in time, let's say a year ago, Somebody told them their property was worth, I don't know, let's use a round number, $10 million, let's say.
Mm-hmm.
Well, that $10 million valuation was based upon a buyer being able to leverage, let's say 75% against that $10 million purchase, a $7.5 million loan, right? And their returns are based upon the remainder, the 2.5 million that they needed to bring to the table to close. So you have a certain level of return minimum. We do. We want to see a 9% average cash on cash return and a minimum of 17% average annual return. So if you have to bring more money to the table, you end up having to dilute your returns. So what we're seeing right now in the marketplace is that a lot of brokers are trying to convince buyers that, oh no, like, it's not that the property's worth less. You just have to put a bigger down payment. It's no big deal. It just means you can't, instead of getting $7.5 million in loan, you're only going to be able to get $6 million. So you need to go get $4 million to go buy this $10 million asset. Well, it doesn't really work that way. So the value is what changes. And now they're just starting to catch up on that. The sellers are just starting to figure out that, oh, wait, it's not worth 10. It's worth 8.
Right.
Because I can only take a $6 million loan out against it. So, sorry, like, it is what it is. So, and it's going to get worse before it gets better. We're at 6. I'm getting debt quotes at 6.5 today. I closed a deal in December. This is now October, so less than a year ago. I put debt on at 3.5.
Wow.
So it went up from 3.5 to 6.5 in a year, like doubled the debt cost.
Yeah.
And because of debt service coverage ratio constraints, you can't take out as much of a loan on the same property. So, and the returns are based upon the amount of capital you bring to the table. So the property's worth less. It is what it is.
Yeah.
If you can't do it. So if you can't put the debt on it at that rate. But, real estate will always continue to increase in value, especially if you have an operator who knows how to properly manage and asset manage an apartment complex is what I do. So it will always be a successful investment. It's just how successful will it be and what's the timing on your exit. I believe we're going to hit 8.5% interest. I think that it's going to go up by another 200 basis points in the next 6 months. And I feel bad for anyone who has either floating rate debt that continues to climb in cost as rates go up, especially if they didn't buy a rate cap or bought a rate cap but didn't buy a good enough rate cap. And I think that there are going to be a lot of people out there who planned for a refinance in the middle of their deal. Right. There's so many deals out there that the returns were reliant upon a refinance, 1, 2, 3 years into the deal. And if you literally have to do that, like if your debt comes due in the next 24 months, it's going to be very difficult to to get the same proceeds that you would have out of that refi. And it's going to be very difficult that if you bought that property at a 5 cap, you're going to be exiting it like a 7, which just eroded away all of your profit or a large amount of your profit because, sure, you executed your value add business plan and increase the net operating income like you normally would, but it was eroded because the cap rates expanded.
Got it. So, but it does sound like, this eventually, although it is a market where deals are harder to find right now, it seems like at some point it'll tip, the scales will tip, and you'll find a lot more deals people are having to sell because they have, their loan is coming due. So do you think we'll see a lot more deals coming in the future?
I do. I think there's going to be a lot of great opportunities in the next 12 to 24 months. And, those opportunities are going to come through people that are being squeezed out, people that put the wrong kind of debt on their property, and people who don't know how to properly manage their asset. I think that there's going to be many of those out there very soon. And we'll be prepared because I can tell you my team is a
Mm-hmm.
very efficient asset manager. We're very good at what we do.
Mm-hmm.
And we always put longer term debt on our purchases. We don't do 2 or 3 year debt. We do a minimum of 5 years. Generally, it's 10.
Got it. Yeah, it sounds like you set up your deals the correct way from the beginning so you don't run into these kind of issues with, economy changing quickly like this.
Absolutely. It will be painful for those who didn't plan ahead.
Perfect. So, to kind of wrap things up, what's the biggest piece of advice you'd give someone who is trying to get their foot in the door into the multifamily space today?
I would say that in general, the best place to start is to invest passively on a deal. Come along for the ride with a skilled and experienced syndication team. If this is what you want to learn how to do, the best thing to do is to do it. Come along as an LP. Learn what that process is like. Review all the paperwork. Review the business plan. Visit the property. Spend time with the syndicators, the sponsors. Spend time with them and learn and ask to ask to bring and add value to the team. Additionally, beyond being a passive investor, and I guarantee you they will take you up on that. So my advice is invest passively in the beginning. Learn, it's crawl, walk, run, fly.
Mm-hmm.
So that's crawling. Crawling is just, is coming along for the ride and, listening and learning and contributing what you can when you can in the beginning. And because eventually you'll learn and you'll be walking, and then eventually you'll be the one running the deal, where you're, running, and then, eventually you're like the key principal main person, and you're flying, and you're just
Got it.
doing all the things.
Perfect. All right. And where can people find you if they need to get in touch?
Yeah, greenforestcapital.com is my website. On there's a button to be able to book a call with me. You can see many of the prior deals we've done before in the past. I'm all over social media, Facebook, Fjord, and it's FJORD. There aren't very many of those, so you'll find me right away. Send me a message, ask, a friend request me. Let's connect. I love having chats with new investors. At the end of the day, reach out to me anytime. Greenforestcapital.com. Let's schedule a discovery call so then you can find out about the next deal that we have, even if it's a 506B and we can't advertise it.
Perfect. All right. Thank you, Lee.
Thanks, Farrah.